Welcome back to Opening Bell. Getting ready for the trading day. David Kudla is with us, CEO and Chief Investment Strategist, Mainstay Capital Management. Glad to speak with you this morning. We've certainly seen a lot of volatility, and folks are even expecting a correction and then higher at the end of the year. But we can't deny that both the S&P and the Dow hit records yesterday, and the Nasdaq's not that far off. What do you make of it?
Good morning, Nicole. Well, I think that there's been a lot of talk about an irrational rally, talk about how far prices are going, hyperscalers heating up again after the doldrums of summer. Some of these stocks are just showing incredible gains over just the past week. But, when we look across the board, we'll see what we get with this deal between Iran and Oman to open the Strait of Hormuz. And we say there's two things here. Strategically, we may not end up as a country with what we were looking for in the Gulf. What the markets care about is oil starts to flow again, and urea and other products. And it looks like we're closer for right now to maybe that happening, and the market's reflecting that. But also it's just reflecting this outstanding earnings season. We're looking at 47% year-over-year earnings growth. We started out with 22% at the beginning of the quarter expected, which is awesome. And we're more than double that. So it's been really another incredible earnings season. In the long run, that's what it's all about. Interest rates, geopolitical events cause noise in the short term, but it's about earnings in the long term. And this has just been an incredible several past quarters, and this quarter particularly with outstanding earnings.
And so you did talk about the rally that we've seen, irrational or not. I mean, you mentioned the word irrational, and so even though earnings have been good because you said they were outstanding, are they merited? Do we have the justification for the levels that we are sitting at with these hyperscalers?
Very, very good question. And the analogy that a lot of people like to go to is the dot-com era. And because at face value, it looks very similar with the price history of some of these stocks just over the past year. The difference is the earnings are there. Back in 2000, stocks were getting priced on number of clicks. There were, companies that didn't even have earnings, much less, decent earnings to talk about. And here, these hyperscalers are these large blue chip technology companies with these fortress balance sheets and very healthy balance sheets that are investing for the future. And I think we already have some early examples of how this is going to work out. There's been this concern about this massive AI spend by the hyperscalers. And we've got an example with Palantir yesterday. Here's a company that has been spending on AI, implementing AI, and generating growth in earnings as a result of it. Just incredible, almost double year-over-year revenue. Stock was up 30% yesterday. But this is an example of a company that has done the spend into AI, and is already realizing the benefits. We're seeing that in the growth of the company, the growth of revenue, and the growth of earnings. And we're going to see this with the others. It's just going to take some time with some of the others. It's the long run. But AI is the future, and it is a significant part of our portfolio, both the picks and shovels and the hyperscalers.
And when I look at some of your picks here today, you went out of that realm a little bit, but you do have a big footprint, and you're staying invested in large cap tech. You also like small caps, for example. I saw that on your list there with FYC, which has been doing particularly well against the S&P 500. Why is small cap still a good opportunity?
Well, as you said, we still like the large cap tech AI space. ETFs we've talked about on the show previously, IAS, CHAT, C-H-A-T, WAR. WAR, which has Micron in there, but also a lot of the defense industry that's benefiting from AI and will with this rebuild and the innovation that's needed, as we've learned through the Iran war, that's needed in the defense industry for new weapon systems. But we're looking beyond to diversify the portfolio, and we always say opportunistically because we're tactical asset allocators. Small cap is an area over the past year that is coming into its own. We've had a lot of head fakes with small cap, but the economy and the markets are turning to small caps that were at the beginning of the year undervalued compared to large caps. They had room for multiple expansion, what they're seeing now. And it plays into the CapEx spend here domestically for small caps to do well. The Russell 2000 is up about 39%. The fund we own that you mentioned, FYC, up over 50% this year. And that's significantly ahead of our large cap index, if you will, the S&P 500.
And then you also had value plays, and that was one of the ETFs you liked, as well as the banks, right?
Yeah, we think, we had the banks' earnings earlier in the earnings season, but some really blowout revenue and earnings for the big banner. And let's be clear here, we like the money setter banks more than the regional banks. Regional banks it's more about NIM, net interest rate margin on lending. The money setter banks, we've got investment banking, their investment management activities, the trading activities, and those have become very favorable revenue streams in this environment of how the economy is doing and how the stock market's doing. So, the financial sector is near an all-time high right now, and we just think the money center banks are a place for opportunity and to diversify our heavy exposure to AI and tech.
So you're staying the course, staying fully invested, still see things going higher, and volatility?
Yeah, we're constructive on these markets. As I said at the beginning of the segment, we're going to have noise because of the Iran. We're going to have day-to-day volatility because of the Iran war for a while, this on-again, off-again war. There's concern about the Fed. We're concerned about the Fed. We don't know what their reaction functions, or at least Kevin Warsh, some of the FOMC board members express their individual reaction functions. But, the markets try to anticipate. They want to discount the future. We want to anticipate what the Fed will do. That's why forward guidance was considered a good thing. And now we're just not sure what's on Kevin Warsh's mind and what he wants to do. So there's things that are a concern, but you just cannot look at these earnings and not be excited about the market going forward. We get into 2027, maybe earnings expectations are a little high. We'll see when we get there as we get closer. But here in 2026, we've just got a banner year for earnings, and at the end of the day, that's what stocks trade on over the long term.
Yeah, another quarter with some great earnings. I think we're up to 7 now. David Kudla, Mainstay Capital Management. Great to see you, David. Thank you so much.